Traders, when you step into the market as a trader, you must treat geopolitics the same way you treat inflation data or interest rates. It is a primary macro driver because it directly alters supply chains, risk sentiment, and capital flows. The ongoing United States-Israel-Iran crisis serves as a textbook case, one that clearly shows how various assets react to geopolitics. Let's see how gold, oil, the dollar, and the S&P 500 respond in real time. Start with oil, because this is the transmission channel. The conflict has disrupted flows through the Strait of Hormuz, a critical artery for global energy. As a result, oil surged well above $100, pricing in supply risk and a geopolitical premium. For traders, this is your first signal. Rising oil means inflation pressure combined with growth risk, a mix that typically weighs on broader markets. Moving on to gold. Typically, gold rallies on fear, and at the onset of tensions, safe haven demand pushed it higher. But here's the nuance traders must understand. Gold later faced pressure as rising oil increased inflation expectations, reducing the likelihood of central banks cutting rates. So gold doesn't just respond to fear, it reacts to how that fear reshapes interest rate expectations. Next is the US dollar. In times of geopolitical stress, capital flows into safety and liquidity. The dollar initially strengthened as investors sought refuge during the escalation. As the conflict dragged on without resolution, the dollar stabilized rather than continuing a sharp rally. This tells you something critical. The dollar acts as a real-time risk gauge, reflecting shifts in global sentiment. Now consider the S&P 500. Equity markets are highly sensitive to uncertainty. At the early stages of the conflict, stocks came under pressure as traders priced in slower growth and higher input costs. However, equities later showed resilience, holding near highs despite the ongoing crisis. This is a classic market behavior. Stocks can remain elevated even as macro risks build beneath the surface. Putting it together from a trader's perspective, oil moves first, signaling inflation and supply shocks. Gold reacts to both fear and monetary policy expectations. The dollar reflects risk sentiment and capital flows. The S&P 500 often lags, absorbing the impact more gradually. The key takeaway is that geopolitics triggers a chain reaction across asset classes. You are not trading the news itself. You are trading how markets interpret and price that news. In the current crisis, oil is leading the narrative. The dollar is confirming underlying risk. Gold is balancing between fear and rates, and the S&P 500 is showing delayed sensitivity. That alignment or divergences where informed trading decisions are made.